This is actually specifically inspired by the fact that Daniel Foch was just on my podcast, and it also opens up a further discussion as to what do we do with this? What are the implications of this? Looking at the trend, and this is one of the things that Daniel pointed out, which I thought was really, really critical. Housing outlook, in my opinion, there is room for it to come down. Of course, the wild card is the immigration factor. So you have opposing forces. We are just in such a housing short supply. On a plus side for most Canadians, I would say, is you're going to be looking at no more interest rate hikes this year, most likely. Welcome back to REI Hot Seat. Andrew Hines here for another solo episode. So my counterpart for most episodes, Jacob Campanaro, is not here today. And he had a conflict, so I decided I'm going to do another solo episode today talking about housing affordability. And this is actually specifically inspired by the fact that Daniel Foch was just on my podcast. The episode just launched on Sunday. If you haven't checked it out, check it out. Daniel is a wealth of knowledge as far as it goes with statistics and the real estate market and the economy in general in Canada and North America. So Daniel shared this tweet on one of his stories. And it says that housing affordability has reached its worst ever levels in Canada in Q3 of 2023. Obviously, this is sort of old data now. However, it's still relevant because we're still in a very similar situation. And you can see sort of what's been happening over time. Obviously, affordability got pretty bad back when interest rates were, getting into the high teens and 20s and the 80s. And then there's a major affordability spike. Lack of affordability spike here in the 90s. And then, of course, we've got an even larger affordability challenge right now. So if you look at this blue line, that's single detached homes. So let's see, where are we, like 60%? Let's just think about that for a second. So mortgage qualification is based on a max total debt service of 44% with CMHC insurance. And GDS is like what's specifically for your house. That is supposed to be typically 32%, but CMHC will let you go a bit higher. Typically, they'll let you go around 40%. But that's most lenders, if it's not insured, they're saying 32%. Maybe some will allow you to squeak up to 34%. This is saying housing cost is like 60%. And that's on average in Canada. And this isn't a doom and gloom thing. This is information, of course, and it's interesting to me, and it also opens up a further discussion as to what do we do with this? What are the implications of this? Well, let's think about this. If people are paying 60% of their income towards their mortgage, I mean, how does that leave room to pay their taxes? Obviously, you've got to be in a pretty high tax bracket to even afford a home in Canada for most people. So there are going to be some pretty high mortgage payments, and a lot of people aren't going to be able to afford this going forward because where's the money for everything else they do, for eating, clothing themselves, doing those things? To me, this signals that a lot of people are going to be selling their houses unless something dramatically changes. So are we going to see variable rates come down? Well, the challenge is that so many people are pricing in, and the bond market is pricing in all these rate decreases for this coming year. There's this bullishness about the economy, which is actually having an opposing effect and likely to stop the Bank of Canada from lowering interest rates because the economy is doing too well. Further to this, we just found out today that full-time jobs and our unemployment rate are steady. So our unemployment rate stays steady at 5.8% in Canada. They're looking for 6.5% or higher to sort of start lowering interest rates, but things just haven't got that bad yet. So this is a fairly stripped out version of the housing affordability. National Bank also published one, and this one's just way more intense. But this is the graph that Daniel had shared, and I figured I'd zoom in on that. So perspective on housing affordability, monthly mortgage payment on medium home price, all types of dwellings, 25-year amortization, 5-year term. So Vancouver probably doesn't come as a surprise, is the most unaffordable. And then we have Calgary coming in near the bottom, also Montreal doing quite well, and then Canada as a whole here in the aggregate. And you can see where things have gone. Obviously, recently, things have really spiked. If looking at the trend, and this is one of the things that Daniel pointed out, which I thought was really, really critical, and it illustrates the point perfectly. The gray bars here are prolonged recessions that followed a spike in unaffordability of homes. And you can see it's sort of like a science here in the 80s when things got really crazy and like 20% interest rates. And then we had unaffordability drop, but that was with a prolonged recession. Same thing in the 90s. Unaffordability drops, housing prices drop, but then you have a prolonged recession. Similar thing here, affordability improves. In other words, these lines come down with recession. So what are we expecting here? And is it going to be a prolonged recession? Well, I would argue that with just how high the line is, I mean, the only time it was matched was back here. Should we not expect a similar type of recession? And this one seems to have lasted about 2.5 years. I mean, I think that like that's what I would be preparing for, quite frankly. But I look at North America as separate. So the US won't have this same affordability issue because they don't have the same volatility in their mortgage rates because they don't have 5-year renewals. They have 30-year mortgages for the most part. Some people take less, but generally speaking, most people are getting a 30-year mortgage, which they're locked in at their interest rate. They're not going to have significant changes. So there's people right now with 2.1% mortgage rates that they're not going anywhere. They're good for 30 years. Very different in Canada. So the housing outlook, in my opinion, there is room for it to come down. Of course, the wild card is the immigration factor. So you have opposing forces. We are just in such a housing short supply that it has that opposing force. So yeah, theoretically, we should see housing prices come down, but then we've got short supply, which is, counteracting that to some degree. So will we see interest rates come down? Most likely we will, but we're probably going to have to wait for the straw that broke the camel's back here. And at that point, that's when we're gonna probably see those rates come down. In 2024, do I think we're going to see some cuts? There's a very good chance. It just depends on if we start to see those major signs of recession, including increases in unemployment and of course, negative GDP growth, all that stuff that are the classic signs, which were pretty much there. It's just it hasn't been felt with severity, which is why everybody's sort of just on the fence. So on a plus side for most Canadians, I would say is you're going to be looking at no more interest rate hikes this year, most likely, but time will tell. Because honestly, nobody really knows. And one of the fascinating things is so many people are taking the Bank of Canada at their word as if they're trustworthy. And I saw a poll out the other day of things people trust more than government. And I can't share what I read on that, but there were some pretty funny responses. And I think that we just have to take it all with a grain of salt. So I like to bring this back to what are we going to do with our strategy? How does that change things? Well, if there's going to be a recession, I'm going to want to be recession-proof. That's looming. We've already talked about that. I mean, what we do with, like, say, our hospitality resort, my partners and I, we target a very we do target affluent customers, but we offer a very cost-effective vacation. So we're actually like a good alternative. So if it's kind of like if people might switch away from steak and switch to pasta, they might switch away from going to Greece and switch to vacationing in Tobermory at our glamping resort. We're very affordable in that regard. So we feel we're set up well to sort of handle that, especially being in like that camping niche, glamping. But what else could you do, right? I wouldn't want to be investing in luxury homes right now. I'd want to be investing in very middle class, easily accessible, most easily afforded types of dwelling units. Multifamilies are great for that because most multifamilies aren't super high end. And if I had an option on a super high end one, I would probably shy away from it. I'd want to be right there, sort of in the middle of the market, but then of course making my product slightly better than the competition because that's just the way I choose to do things because I don't want to be competing. I want to be clearly better with my product. But then I'd also look at, okay, well, could I go to the US and be slightly protected from the housing prices fall off that might happen here in Canada? And it all depends on immigration here in Canada. So I would look at that as a bit of a hedge. At very least, I would say that I'm sort of hedging against one scenario by going to the other country. I'm hedging against one economic climate and going to another because they are distinctly different, Canada and America. So I notice so many investors that are at least dabbling in the US as well, or dabbling in another province, but a lot of people are now sort of starting to dip a toe into the US market as well. I think it's a great time to be looking in Canada for sure because, I mean, sellers are still not getting lit up with offers right now, although there is a little bit of a positive sentiment. I've heard that in Toronto that sales are up, and I haven't confirmed this with data yet, but if that is true, the ripple effect will make that spread out to all the surrounding areas. And you're gonna have Golden Horseshoe and all the way down to Windsor, et cetera, starting to pick up. So this in my mind is because of the recent mortgage rates coming down, bond rates coming down, that bullishness about the Bank of Canada and the Fed dropping interest rates. That's where their heads are at, but they might be overly optimistic is sort of just the point I wanted to make with that. So I'm curious what you think. What do you think is going to happen in the economy in 2024? Are you predicting recession, significant recession? Are you predicting just that soft landing that a lot of economists predict that central banks will try and create? Let me know in the comments. Share this episode if you thought it was helpful, and I will see you again next week.